Our business is all about, and all finance is all about risk mitigation, right? So our idea here is on the repayment side, we're never having to chase our clients. We're never having to chase our clients' buyers for repayment. We're always exited by a financial institution. On the flip side, we're never handing capital directly to our clients. Now, there are exceptions, but most of the time we are paying our clients' suppliers directly. Much like purchase order financing, if anybody's familiar with it, but we're not a PO financer by any means. We don't put people through that torture. Anyway, as far as time frames go, why I mention that is, usually manufacturing type financing, whether they have one supplier or 10 suppliers, and it needs to go through different phases, that can affect our time frames. But usually manufacturing, you don't see deals going out over 120, 140 days. So it's short term where we would pay the suppliers, they would ship it to the client would go ahead and make the product. Once they make the product and there's evidence of it, a factor, a bank, an ABL lender, whomever it would be, would take us out of the equation, and now they would go ahead and offer 30, 60, 90-day payment terms to the end buyer. So on that type of financing, it's usually generally, very short. On real estate could be a different situation. So on a real estate transaction, which we've just done recently, say a bank is, a client wants to build an office building or buy an office building, whatever the case is in this scenario. And the bank has already approved the deal, they've met stipulations, and they're just saying, hey, we need, 60 days to allocate and close. Well, the client might have already had an agreement in this scenario with the landowner or the seller, and the bank can't close quick enough. Well, we would step in, buy the land, and then eventually, whatever the time frame was, 30, 60, 90 days it was, the bank would exit us from the transaction. We can do soft funds, hard funds, or like I just explained, literally purchase those items for or on behalf of the client for the bank to exit us. We've done deals up to 12 months on those type of transactions. Obviously different scenarios due to the fact that, you don't have a bank guarantee and a bank telling you they need a year to close, but we knew we could get this particular client bank financing. So we would go ahead and purchase the first step for them, use one of our contacts or our syndicate exit lenders, and then they would come in, issue the approval, and take that client out. So I would say longest would be about 12 months that we've done. So on manufacturing, usually we look at the annualized basis. So if anybody's familiar with factoring, I keep on bringing up factoring on the manufacturing side because most clientele want and are factored. They give their clients payment terms. So if they need assistance with raw material or manufacturing that product, we'll really mimic what the exit lender will do. So most factors want to have an annualized commitment from the client. So if it's on a small deal, most factors really would want their clients to do a minimum of at least $1 million a year. And that would be a small factor. We have done spot deals with spot factors as well. And, if we see growth, potential growth in that client, I've done one deal with a client where we did his first deal at $55,000 because we knew he put in about $2 million to buy material he was just short. But we knew the next times around, we were going to be financing 2.5, 2.3, every 30 to 45 days. So if we know there's potential for growth, really, there's nothing too small. I shouldn't say that. We're not going to do a $10,000 deal or a $5,000 deal, but even a $50,000 deal is kind of ridiculous. It's not worth our time. But if there's growth behind it, and we know that, and we can see that, we'll take on the opportunity. Now, outside of manufacturing, totally different story. I keep using real estate just because it's an easy situation, lines of credit or growth. I would say our minimum hovers around anywhere from $1 million to $1.5 million. I mean, realistically, common sense is what we focus on. When I was introduced into the AR world after Lehman, and we shared an office with these guys as they were growing, that were a factoring group. And I just looked at these guys and said, why are you turning this business down? Why are you turning that down? They're like, we only finance receivables. I'm like, but you've known that client for 10 years. You know he's just short on capital to go needing the money to create this particular PO. And they would say, oh, that's all we do. And they said, have them go to a PO financer, and they'd kind of giggle, because any factor will tell you, PO financing is a fantastic idea. Getting it closed, a completely different scenario. What those guys put you through is asinine in the PO financing world. We've simplified this so much. As I said, mitigation of risk is the main component here. When I know I have a client in place that knows how to build or create or has history in his industry, and I have confidence from his past and future, and I looked at whether in manufacturing, his suppliers, I know that they've been around a while. Maybe there's even a history between supplier and client. If there is, even better, right? The more history behind these two together is even better. But even if it's a new situation, and I know I have a solid supplier that essentially has the product or has what I need upon payment, I'm confident they're going to send it over. Now I don't have mismanaged use of funds from the client. I don't have to worry about him making business decisions, really. We're kind of in control of the deal, where we're sending him what he needs. He makes what he needs, and I know that I never have to go chase money. I know these exit lenders are going to abide by our contract. We have long enough relationships that I know our trigger point, if you will, that we're set for them to exit us, they will take us out. So I'm never chasing money. So really think about it. My underwrite is, do I have a client that has history, and am I confident in what he does to build or create or do what his job is in this situation or what he needs the money for? Do I have a solid supplier? And can I bring on an exit? Now, we do want to look at financials to ensure that they're not going to go bankrupt during the time of our requested loan amount. We want to make sure there's no major liens, any major litigations. We do underwriting. It's not just, this guy knows what he's doing. He tells me he's been in business for 10 years, so let's finance him. So we do look, but it's just not the strenuous, tedious craziness that other PO financiers put you through. And again, I don't want to compare myself. I've tried very hard not to consider myself a PO financer. If anything, we call ourselves a exit-based lender or a pre-receivable financier. I just got a call the other day from a guy that told me he submitted an application 2 months ago in with a PO financier. He sent us the file, that thick of a data room. We picked out what we needed. We were able to close this guy in 7 days. He couldn't believe it. I mean, it's just much more, as you mentioned, common sense. Does it make sense? And really, that's how we look at all of our deals. Do they make sense?
So about him, if I may, we work with a number of bridge lenders at Alphonse Global. What differentiates him is his integrity. If he says he'll call me, I can go to bed knowing he'll call me. And he may say he'll call me in half an hour. That one rarely happens. But before I go to bed, I know he'll call me. He's very good with follow-up. Privileged to work with. I'll go to battle any day as long as he's in my team. I'll go to battle with him any day. We work on multiple files with each other. But what I would say differentiates him, because we have other bridge lenders we can go to, I would say what differentiates him is his integrity. And I know I've met his major investor, and his partners, and we know their team kind of thing. Integrity stands out for sure.
We would really always mimic what our exit can be, okay? So again, most factors will cap out at 80% loan to value. Real estate, can go as high as 90 depending on deals. But we always need to make sure that we, even with our interest and fees, is within that LTV of our exit. Obviously, I hate to be so broad here, but that's kind of the beauty of what we do, is that it's really open to whatever the exit lender is willing to do. So, but I've seen 90% loan to values that we've done. But again, on the bridge though, remember, that's more like maybe anywhere from 82 to 80%, because our interest and fees are in there. So, it really depends on the exit-based lender. I mean, a perfect client comes to me and says, hey, I already have a bank that gave me approval. They're not going to fund for 90 days, but I want money before it. Or, hey, I've been factored with CIT for the last 20 years, and I just need an advance on this PO. They're already set up. Now, and to flip it around, client comes to me and says, I never even knew this existed, which a lot of clients do. And they've been in the business for a long time. They know what they obviously have a long history within their industry. No problem. Also a great client, because I can set him up with a exit factor, bank, whoever it is as well. So again, perfect client also keeps to always being able to bring in an exit. One company that always stands out in my mind is that sold computer components. Small company, only about 20-something employees when they started, but they were really struggling. They were savants with what they did, but as far as running a business, they really needed help. They've made a lot of bad decisions on lending, a lot of merchant cash advance loans that were just crushing them, a lot of high debt. So I told this guy, I said, hey, if I can finance you all day long. I said, that said, if you listen to what we have to say and you allow us to kind of guide you. We're not here to run your business or take equity or anything like that, but we really see promise within this company. At the time, he was doing business, but again, his debt was crushing him. So, I mean, they were doing tons of business, but their year ends just looked awful. I mean, because they were just giving it all to the lenders. So anyway, we started with this guy. We paid off a lot of his bad debt. He had a lot of outstanding receivables, constant, he had a great portfolio of continuous purchase orders and had great receivables on his books. So we brought in a factor for him. We gave him a hybrid type pre-receivable / line of credit that he could fund off of. Anyway, within the first year, we got him profitable by a good amount. And every year he just kept growing just unbelievably. This guy's doing about 26 million a year right now in net. 10 or 11 years ago now, barely breaking even. Not even paying himself a salary so we could have, the owner not even paying himself a salary so we could cover his employees. So, I mean, that's one guy that I'm truly happy for because he's such a good guy. They got a great team, great business, but that's a great story because we saw that in the beginning. I mean, we only started in 2015. So this was like one of our first big clients that we saw just massively stack up and just continue to grow. So that was a great success story. There's a lot, I gotta say, so many people come to us and they're like, I didn't even know this existed. Or, hey, I've had so much trouble with a purchase order finance company. They want everything, including my blood type, and I get it. So it's really rewarding to be able to help people in an easy way, make them just in shock that this exists and how simplified it is on a weekly basis. I wish it was daily basis. I could say we had closings, but weekly basis, we kind of have a really good situation going on over here. Commercial financing, we can always set up if the client doesn't have or the client's looking for, we could set them up. I mean, we're not cheap, right, as far as bridge lending. We're not, crazy hard money. I mean, we can get into single digits, but we hover around mid-teens. But that said, once we do whatever other lenders won't do, and they say, hey, we need them to get to XYZ position, or we need them to show additional liquidity for this assurance bond, or whatever the case is. It's not always going to perm financing. There might be a stage in between. If they're in the position where they have enough liquidity and capabilities that they could build whatever they need to with assistance from us in the beginning usually, right? Because we're not a full construction loan. On those type of projects, we're usually coming in to assist them with purchase of acquiring the land, possibly getting permits or things of that nature that we know, there's incentives or reasons that they will be approved. I mean, we don't love a permit type situation, but we have done it. But yeah, no, it's not always going directly to perm. It could go to XYZ financer first, a family office. It could go to a hard money lender. It could go to a bank that's offering them, a short-term 5-year, deal or something. But usually it's not going to a bank, right, in the second stage. If we could get it to go to perm financing, fantastic. But I would love to see it go to perm right after us because it's a lot cleaner. But most of the time that doesn't happen. So we have lenders that can specialize in that place to just exit us and then be taken out by perm. We've worked hand in hand with construction type lenders, right? Where, we've done a deal with where we were purchasing steel for a particular company. And they were buying, which blows my mind, and how I learned about so much steel coming out of China and not so much here today. You would think that would be a fortune to bring it over here and all that, but that's where your steel's coming from these days. But anyway, we were handling that almost like, our typical trade finance deal, right? Where we were creating a letter of credit overseas. The supplier would go ahead, allocate the product, then they'd ship it over. Once it got here, we'd be exited. Or the LC would be, obviously paid out too. Either way, it was structured. But as far as us doing actual physical tranches of the construction, they really need, I don't want to say no. We haven't really been in that space too much because you have people that specialize in the construction phase. We've assisted with certain things that need to get completed, but we're not, really advertising or looking for just straight up, hey, you build the foundation, we're covered. You don't really get exited after the foundation. Now you go to the framing, you don't really get exited, right? You get more hits of capital that come out, but it's usually a longer term to build something that we're more of a short-term lender. So not so much just straight up construction. We will look at anything as to collateralize against, or sometimes we have such a strong lien or as a blanket over them, or we have a UCC in place with a product, an item that might not be part of the actual project. So there's different ways that we can collateralize what we need to do to get security. But at the same time, if it's something like you're shipping over or bringing something to the table for the project, we can be covered by, straight up trade finance type of, where there's no collateral involved. The item essentially is the collateral.
Does his business model make sense? He says, look, if you need capital, as long as you've got the exit buyer on mind, I'm going to fund you. Does that make sense? Look, I know a lot of bridge lenders. A lot of them will fund you from A to B. He says, as long as the exit guy is there, I'll give you the entire funding.
On the real estate aspect of things, so for example, we had a gentleman that needed quick capital. Right? He needed $3.9 million. He had a free and clear property that was at $17 million. And he needed this within, a short, really less than 2-week period, calendar days. So he came to us. And on something like that, that's easy peasy really for any lender, right? You go in there, get title in place, make sure everything is truly free and clear as he stated, and that's an easy deal for anyone. On another flip side, like I mentioned earlier, was acquisition of property, right? A guy that has just been through the ringer with his bank. They're a great bank, but as we know what it takes to close a deal these days. And the seller was just short on time, trying to ensure that he, got the deal done, didn't get penalized. So we bought the land, knowing the bank was going to come out. It's mostly timing situations in real estate. It really is. Now, on the flip side, what we really, where most of our business is real, I would say at least 75 to 80% of our business is in more of raw material or manufacturing or. Real estate really is easy if it's just timing situations. That's why people would come to us, just straight up time. They need us to move quick, that's what we can do. But again, a story would be, I just want to make everybody understands the flow, right? It's essentially we would come in, just vet out, make sure we have a solid clientele, that they know what they're doing, making, these jackets. They go to a trade show or something like this. A buyer from Walmart walks up to him and says, I want to buy $10 million of these jackets. I love them. So this client has been small, a smaller company. Let's just say they're doing, $300,000 a month in revenue. Well, now all of a sudden, most likely this guy's going to go to his factor, and he's going to say, hey, I got a $10 million PO from Walmart. This can change our whole business. They want to put me in 1,000 stores, blah, blah, blah. All right, well, let's say they're at 50% profit margins. Usually that's what you are in the apparel space, or a lot more. So he needs $5 million for cotton, polyester, whatever these coats are made out of, right? So in that situation now, we'll go ahead, we'll pay his suppliers. Well, first we'll make sure the suppliers are solid, underwrite, as I mentioned, but we'll pay the suppliers. That cotton and polyester is sent to him. He now goes ahead and manufactures this product. Once the product's made, let's just say the trigger point was a shipping label. Shipping label is proven to both us and the factor. Now it's considered a receivable, or sometimes it has to be delivered all the way to the client. Not upon reception, just physical reception, not if there's any issues. That's the beauty of it. If there's any issues with the product, that's the factor's problem. But once it's considered a receivable, factor takes me out. Now that factor offers 30, 60, 90-day payment terms for Walmart to give them time to sell it. Once that, say, 90 days is up, Walmart pays the factor back, and now the factor will go ahead and give that client his 50% profit margin.
Who's your ideal client?
Like I said, if they have an exit, they don't need an exit. It's really just a client that, all clients that can actually get you the right documents. You can vet a client very quickly in this business, right? You can know if they're gonna have an exit or if it's gonna be tough finding them an exit. But realistically, client that's been in business for some time, same industry, knows what they're doing, has a solid business, knows that you can get them. I know you can set up an exit for them. That's a good client that we could do all day.
Awesome. Can I just say one more thing about him? I think I should be your sales guy, if I may.
I thought you were. I gave you money earlier.
You did give me money, that's true. So no, he can also take SBLCs.
Yeah. Oh.
He has the capability to do SBLCs, and that's very rare. And I've talked to the lady he uses to do SBLC. So if you have SBLC as an example, like if you go out in New York and talk to other bridge lenders, they'll be SB what? How do I get that?
Expanding on exits, yes, SBLCs, and this is rare, but we'll even utilize escrow. Right now, I'm not sure if you guys, I just found out about this, there's a shortage on saline bags right now. I guess from the hurricane that happened down in North Carolina and wiped out one of our big manufacturers of saline bags. So I got all these people calling me, asking me if they'll bridge to get this product into the country. So essentially what they want us to do is they have all these buyers that are ready, willing, and able to put up money in escrow after they get, verification that the product is here in the States and that it all meets the requirements. So they're basically looking for somebody to pay manufacturers/distributors overseas, bring it in. Once it clears customs or once it's delivered to their warehouse, escrow is released and we're paid. So this is a situation that, is where we would use escrow. That's a no-brainer on those type of deals right there. We're paying major manufacturers, only 8 allowed that the FDA is allowed into the States right now, and they're all like Braun and Baxter, they're all massive companies. So yes, we would use escrow in that situation. SBLCs, yeah, Tamar has a deal right now. Solid tier 1 bank. Really, we would only work with specific banks on the SBLCs. I think we all know SBLCs are one of the most frauded type of instrument out there on the market right now, or in the industry right now, or for a long time. So yeah, once and if we can verify the instrument, it's definitely something we could do. We have multiple deals with bank instruments as well. So most international deals will use a letter of credit, not a standby letter of credit. Yeah, protects all parties. Domestic, yeah, just cash, but yeah, internationally, 9 times out of 10 we'll use an LC. Sometimes they want cash backed, right? But you're right, a lot of the times we're not. And I'll tell you what else is cool about the industry is a lot of times we can even work out terms with our suppliers after a long time. So that's usually after we built some history with them and they see every time Every date we told a wire would be there, it'd be there, so they know we're good for it. And then we say, hey, you know, whether we are or not, hey, it's been 2 years or 6 months, a year, whatever, we're kind of tight on liquidity. You know we're good for it. Would it be all right if we still ship, took care of the client? And, you know, you do that once or twice. You say, why don't we start making this a regular thing, you know? So, two different things. So on straight up bridge loans, right? Our money varies anywhere from, I'm gonna say 9% to 16%, depending on, you know, risk reward levels. On the straight up pre-receivable financing, we're anywhere from 2 to 4, call it 5%. That's per 30 days though. You know, we've done some riskier deals that have been up in the 4.75 range. But most of the time, you know, the clients that we're bringing, our average rate I would say is 2.75 to 3.25 per 30 days. We can do soft, we can do hard. Hard money we can, and I don't mean hard money in lending, I mean money that actually moves, right? Soft money is usually money that just stays, you know, with us or doesn't really have specific needs of where it needs to go. It's a very soft type of look-see, if you will. On the other hand, you know, what we do to mitigate this, to have it look, and again, this is a business. People just do this. I know it might sound shady that people are looking for this, but this is a business. So what we would do is we would put money actually in create an account in your client's name. It would be under ABC Construction or whatever the name of the company is. They would not have signatory rights. We would still be the signatories on the deal, and that money would sit for X amount of time that he needed, and he would pay X amount of fees for that. So yeah, that's a very quick vet and close on that. Really, all that is a quick vet and background on the client. You know, we obviously know we look at it as not the most moral situation. But again, banks, everybody does this all day long. Like we did a deal the other day where a client needed to qualify for a bank loan was short $3 million in liquidity. We did the same thing. Got him, the bank approved it. You know, so same idea. But yeah, here it's background check on the client, little background on the company. We set up escrow where the client puts, you know, whatever attorney charges to set up the escrow, which is pennies, it's more of a commitment. And at that point, the client would put whatever the fees would be on that we agreed to for the use of the money for month one or, you know, however we design the payment to be. And money's wired into that account within, you know, that day. It's very quick. We've closed those type of deals within 3 days. Yeah, on pricing, I really, you know, on those type of things, because that's not really done with my in-house investors. We have an outside source that does that. Yeah, we want to verify that SBLC directly with the bank, make sure that's valid. You know, obviously the verbiage within the SBLC is important, transferable, all those things. So yeah, absolutely. I mean, the SBLC is the collateral in that situation, so all day long, we do a lot of important digging into the SBLC. You have a company that wants to do a capital raise. They want to sell off 35% equity within their company for $300 million.
Right.
So they found a buyer that wants to do it. Went through due diligence. This company happens to be banking and have lines with a tier 1 bank. They are primarily a project finance company. You know, a lot of ERC type deals with with energy and stuff like that. A lot of building, construction. So they're used to putting money out in tranche schedules. Now, this is their first equity play, essentially. They're buying 35% equity for $300. Their bank came back and said, we love the deal, but unfortunately, we're not going to be able to let you just release funds in one shot, like you're not an equity firm. So we're going to still have to draw out funds, or we're going to have to go back and get you approved, which is another 4 to 5 months of underwriting from us just to do that type of transition. So they made a deal with this seller that they would release $17 million every 30 days for, what was it, 16 months?
Yeah,
18 months, something like that. Well, the client wanted to work with, the seller wanted to work with this group, even though it's not ideal. And then they came out and said, well, maybe we can get a bridge against this $300 million commitment, because essentially they're transferring equity at time of signing. Equity's not going over monthly. All 30% is going over based on the contract and the commitment that they have in place. So essentially, we'll step in, we'll do a,
Bridge loan.
letter of direction where that 17 million will come to us every 30 days. But in the event that for whatever reason happens, that the buyer says, you know what, we just found out that this client's medicine causes cancer, or whatever the case is, and they said, we're done making payments, this 35% equity is garbage now, we still need something to protect us. So essentially in this deal, Tamor is actually coming into this deal where he's putting up
$500 million.
$500 million that he's putting into this depositor as a deposit into the bank that this lender works with. They're converting that into CDs, and they're also converting a portion of that into a letter of credit for us, or you can call it a bank guarantee, a standby letter of credit, whatever you will. So we're protected now, where we're taking in 17 million every month until we're paid our full bridge that we're immediately giving to the seller. If they don't pay for any reason, we have, a bank guarantee, SBLC, LC, whatever you want to call it, in place where we walk right into the bank and cash that in for what we haven't been paid for yet. So that would be our protection, and that's where the magic of this man comes in.
What a lot of people, for some reason, don't know or don't understand why, is that I can go buy CDs from banks and make a condition that my money is not collateralized. The client has to be the one providing the collateral. I'm just providing the liquidity. I just don't understand why people don't understand that. I've done that so many times. So I call the bank, I say, hey, I'm going to buy $500 million of CDs from you. Yes, great, thank you. The deal is, you cannot collateralize my CDs. Okay, who's providing the collateral? The client is. Client comes up with you. They say, fine, no problem. So I go buy $500 million of CDs, and then 48 hours after, the client gets, I said, $300 million out of it. But for the client, it's debt financing. They don't have to give equity away. With private equity, they have to go through audits and things like that. They don't have to deal with that. It's just straight debt.
Credit enhancement.
Credit enhancement, right? Just like so easy to do. So if you are in the world of, I need a lot of money, and joker brokers tell me about SBLCs and there's a lot of fraud in it, I personally think the alternative to SBLCs is the CD thing, because who you're dealing with is your own bank. All I'm doing is I'm buying CDs from your bank on condition my money is not collateralized. Now, the benefit to the bank is that they're not paying me a penny for me to put up $500 million. That's a big benefit to the bank. The client's the one who's paying me for my fees. Yeah, so it depends on the transaction. We have transactions with credit unions where, so in the 1950s, when Anglican churches were born in the United States, as part of the deal, the Anglican Church built a credit union, so it was part of the deal. So today in the US, you have a lot of credit unions, like a lot of credit unions. These credit unions are not banks. They're just not banks. They don't have people depositing money with them. So the way that religion works, if I can call it religion, is you have your members making a deposit, and then you loan money to members. Well, they're trying to get into real estate. They're trying to get into multi-residential. They want to get into lucrative transactions. So if I can go to that credit union and say, I'll put up, Joe here needs 10 million. How much do I need to put up? The guy will say 10.3, no problem. I'll put the 10.3, and Joe's going to bring you a multi-residential property. What's the collateral? The property. Where's the liquidity? 10.3 is coming from me. He takes 10.3 from me. He gives 10 to him. He has $300,000. For a credit union, small credit union, $300,000 is a lot of money. Guess what? He gets to loan that money out. You know what happens with that 10 million? He returns it back with interest. You know what happens with that 300,000? Goes back with interest. You know what happens to the CEO? He now has another $10.3 million that he gets to loan out again and again and again. They love the CD thing. It just makes a lot of sense. Now, we started with a lot of small credit unions, small private banks of that. Now, a lot of my transactions are with major banks on the exact same program. I think it took us a lot of time to, I don't know what happened, maybe put time and effort into it for you to get traction, but now I'm doing this with Bank of America, Royal Bank, like big banks. So for those ones, yeah, for let's say every $100 I put in, I think they'll give the client $90, $95, some version of that. And the small, but the bigger banks, no, they don't, well, from every $100, they'll put $40 $50 bucks. But still, the financial benefit to my client makes a lot of sense. You know what I mean? Like, I know in the United States, I'm considered a foreigner. So when I want to get a loan here from Bank of America, it's like prime plus 18 or something like that, right? When I do the same program for myself, I do the same program for myself in the US, it's prime. Why? Because I'm not depositing 20%, asking for 80%, I'm depositing 150%, asking for 100%. So it changes the underwriting, so my cost of capital becomes prime. Well, I'll do that any day.
Again, that 75 that I'm quoting you, that, basically $1 million to $100 million, that's just for that 10 to 30 days. I'll get you guys pricing on what it would be, 3 months, 6 months, and so forth. But their bread and butter is, again, this is a different investor than the equity firm that backs me. But like I said, what they were normally doing was, okay, Joe Blow wants to buy masks. All right, I need to show this guy capabilities to purchase, no problem. They'll set up the account, put it in the guy's name, shoot it over. All right, bank comfort letter goes over, or an MT99, whatever. You would know that, how they check the account. Once the account's checked, it's their job, to just say, okay, deal, these guys are good. So you don't really need the money for more than that time frame. It's really just the time frame that the banker or whoever's going to call and verify is going to call. So 15 to 30 days is what they usually give you. Now, we've done deals with different scenarios where we needed to show liquidity in a client's bank account for them for 3 months, for 4 months to show X amount of dollars to get an approval from a bank. So there's different ways that it can be done, but I can get you guys all pricing on that. Don't get me wrong, we always want to protect ourselves. We are diligent with what we need to do and what we're concerned with, but at the same time, speed and simplicity. A lot of the things that people get today, even banks get today, you're just like, why are you asking for that? Like, how does that affect the deal in any way?
Awesome. Thank you so much.